Hi friends, now in this session we will revise three most important readings of our curriculum, and these three readings are from book 4. So reading number 1 is measures of financial risks, reading number 2 is calculating and applying VaR, reading number 3 is measuring and monitoring volatility. We will discuss all three readings in one revision session. Reason is very simple, because these three readings are the part of package known as a value at risk. Okay, so all three readings relates to the value at risk, and when we discuss these three readings in a combined format, you are able to understand it in a better manner. Okay, so let's start with our discussion. Now, before we begin our discussion, one more thing. I expect you to at least read these two chapters once before you watch this video. Okay, otherwise you won't be able to understand everything. Even if you have read it once or understood it once, and maybe you are unable to understand few things, don't worry. After watching this video, you will understand each and everything, and you will be able to solve questions in your examination. So this is exam oriented revision. So let's start with the risk measures, financial risk measures. So what are these measures? So we know primarily three risk measures. So standard deviation, value at risk, and expected shortfall. We know we use standard deviation in the calculation of value at risk, and in some cases we also use value at risk in the calculation of the expected shortfall, or we can simply say the expected shortfall is based on the value at risk calculation, right? Again, this from the calculation perspective. Now here, if just a second. Okay, if someone asks you to calculate the standard deviation, we know there are three methods for the calculation of standard deviation. We know first one is the formula, which we know, which we all understand. The formula is under root x minus x bar squared divided by n minus 1, assuming this is a sample. Second is the implied volatility. And third one is these models, time series models, so EWMA and GARCH. This particular discussion is covered in reading number 3. So we will discuss this particular part when we will cover reading number 3. So let's set it aside. Okay, now. Next is the value at risk. So we will come back to standard deviation discussion, but we'll first cover the value at risk discussion. Now, in value at risk, we have first concept, which is calculation of value at risk. Second is the interpretation of value at risk. And then we have some miscellaneous discussion relating to the value at risk. So let's start with the calculation part. In case of the calculation, we have two approaches. First is the non-parametric approach. Okay. Non-parametric approach. And then we have parametric approach. Okay. So non-parametric approach and parametric approach. In parametric approach, we use sigma. In non-parametric approach, we don't use any parameters, and that's why this particular approach is known as the non-parametric approach. When we are solving or calculating value at risk using the non-parametric approach, we have to consider few things. Okay, so these things relates to the data. Okay, so first of all, which data to use for the non-parametric calculation, non-parametric value at risk calculation? So first option is using historical data. Second option is use simulated data using Monte Carlo simulation. In exam, we don't have to bother about the data is Monte Carlo simulation or the historical simulation when calculating value at risk. Irrespective of what type of data it is, we will do the calculation in the same manner. Okay. Now here in historical data, we can directly use the pure historical data, take the previous 100 days observation and calculate value at risk. This is one approach. Second approach is use the simulated data. Simulated or historical now historical simulated data and historical data. Historical data means you take pure observations past 100 days and you go ahead with that. Then historical simulation. We simulate historical data using the parameters like the market parameters. Maybe we will use the inflation, maybe we'll use the market variables, volatility, and so on. And based on that, we will simulate the historical data past 100 days observation instead of taking the actual observations. This particular approach is better because it will be able to give you the more linked picture, okay, so more related picture. But for example purpose, you have to just understand what is the basic meaning of the historical simulation or historically simulated data. Then we have the Monte Carlo simulation. In Monte Carlo simulation, we use the parameters like the sigma, mean, and using these parameters we simulate data, and then we use this data again where in the calculation of value at risk. Once we have this particular data, either from the historical simulation or from the Monte Carlo simulation, our steps start. Okay, so here the steps are very simple. If you have 100 observations and if you're asked to calculate 95% value at risk, then 95th value, or simply if you are going from 0 or negative, then the 5th value is your value at risk. Simple. And the expected shortfall in this particular case is remaining 4 values. Okay, simple. So you have to take the 5%, that is the alpha significance level. Take the 5% of 100. So 5% of 100 is 5, right? So you have to take the 5th value, lowest 5th value. If we have say 200 observations, then we will take at 5% significance, we will take 10th value is our value at risk. Fine. This is very simple. So 100 for 100 observation multiplied by significance level, whatever is the value, that value is your value at risk. Now here you have to only focus on these particular, like these points. So are there 100 observations, 200 observations, and so on. If you make a mistake in this, if say GAP says in question, there are 200 observations and GAP provides lowest 10 observations, and by mistake you simply take the 5th value, you made a mistake because you're supposed to take the 10th value. That's it. So this is the first thing. So the calculation of value at risk. If we have to calculate say expected shortfall, so in this particular case, so lowest 4 values will be used for the expected shortfall calculation. For the expected shortfall calculation, this is simply the average of lowest 4 values. 4 values in this particular case, that is the 100 observation 5% significance level case, and 9 values, average of 9 values in 200 observation case. 200 observation at 95% confidence level and 5% significance level. Very simple. Now we have the parametric approach. In parametric approach, we all know there are 2 formulas generally given in the book. So the formulas are, just a second. There are 2 formulas. So value at risk at the given percentage confidence level, and we are calculating the percentage VaR. So first formula we know is the minus mu plus Z into sigma, and this is the percentage VaR. If you want to calculate the dollar VaR, then you have to simply multiply this setup with the value of your portfolio. Simple, very simple, right? Now here we have this mu, and this mu ideally should be used only when you are calculating value at risk for say month, year, like that. Okay, so for the higher period, if you are doing the, or you are using the observations like the daily observations, then we can simply use the formula, which is percentage VaR is equal to Z into sigma. That's it. This is more than enough. Okay, so again, non-parametric approach. So we saw the percentage VaR, the formula is Z into sigma, or minus mu plus Z into sigma. And then if you have to calculate the dollar VaR, simply multiply it with the, for dollar VaR, simply multiply it with the value of portfolio, multiplied with the value of portfolio. Now, why are we taking mu in this particular case and not in this particular case? Why are we dropping one particular value and it is not affecting our calculation? The answer is very simple. This is mainly applicable for the daily data. And I have simple question for you. If you have say a particular stock provides the return say 12% per annum. So what is the daily return? So for the daily calculation, you can simply do this, assuming the 250 working days, and do the calculation. So 12 divided by 365, sorry, 12 divided by 250, and this is 0.048%. And this is so low value, this is so minuscule. So it is not going to affect our calculation when we are calculating the value at risk using the daily observations. Okay. So this we need to understand. So even if you are not provided with the mean return, then you don't have to worry about it. You can simply go ahead with the Z into sigma and it will still give you the proper calculation. Now here some students make this particular mistake. They use the formula like this. So the formula like plus mu minus Z into sigma. Don't use this formula. This is not incorrect, but still this will give you the answer in negative, and VaR is not quoted in negative. Okay. So it is always a positive number because VaR itself, this means the losses. So losses don't need to put in the negative sign, right? So we got our value at risk calculation and the dollar VaR calculation. Now here, what is the sigma? Sigma we will learn how to calculate when we will discuss the reading number 3 calculation, monitoring and measuring the volatility. Now here we have the Z value, and the Z values should be remembered. The common Z values are, this is the confidence level, and this is your Z value for 90%, for 95%, for 99%. Okay. This is getting really messy. Just a second. Z values for VaR must remember. Okay. Now this is the confidence level, Z value for 90%, 95%, 99%, and the Z values are 1.28, 1.65 and 2.33. So you have to use the one tail values. If we plot the normal distribution, not at all looking like a normal distribution, but yeah, we can manage with this. Just a second. Okay, so if this is the normal distribution, we are asked to calculate the VaR, and this is your negative side, that is the loss side, and this is the profit side, and maybe this is the profit. So center is a profit or loss depending on the scenario. So value at risk at a 95 confidence means the 95% area is here, 5% is here, and the cutoff point is the value at risk, and this remaining area, whatever the values are there, the average is your expected shortfall. Okay. So this is the parametric approach, and in parametric approach, then we have to see once you get the value. Okay. So once you have your value at risk, then comes the concept which is known as the in calculation only. Then comes the concept which is known as the translation. In translation, we have two types of translation. One is the time translation, then we have the confidence level translation, and in exam you can get the time and confidence in translation combined question. Imagine for now the value at risk at 95% is equal to, and this is daily value at risk, daily VaR. Daily VaR is equal to say $10 million. Just assume for now. Now, if you have to calculate say annual VaR, again same 95%. Now here what we need to do? First we will need total number of days. Let's assume total number of days 250. GAP will specifically provide you total number of days in a year, so you don't have to bother about it, right? So for this particular calculation, we have to increase the time frame of value at risk, so from 1 day to 250 days or 1 year. So for this, simply take your 10 million value at risk multiplied by under root of 250. Always remember the time translation of standard deviation and value at risk both are done by under root. So you have to put the value in the under root. Why? Because standard deviation is used in the calculation of value at risk, and this standard deviation is the root of your variance, right? Or variance, whatever you prefer. So this was the variance or variance, sigma square. Sigma square is translated by number of days, directly days, and standard deviation is under root of variance or variance. That's why we have to take the under root for days as well. And whenever we are using standard deviation, and we are multiplying time with it, it is always by under root. You can recall the Black-Scholes and Merton formula. we are multiplying sigma multiplied by under root 2, right, in the denominator. So why are we multiplying by under root 2? Because sigma is always multiplied or divided depending on the time translation, wherever you want to calculate or the way you want to calculate. The time translation of sigma is always done in the under root, and we are using sigma in the calculation of value at risk, and that's why for value at risk the time translation will be done in under root, and this will give you the annual VaR. So annual VaR is equal to 250. Okay, one more thing for the historical simulation and all. Okay, so I skipped the illustration because when we will see the book, in book there are illustrations and I will show you all the illustrations. So right now don't bother about the illustrations for that particular part. Now for the time translation, this is simple. So you have to simply take the 250 under root multiply 10. Whatever is the answer is your annual VaR. Now what if we want to calculate the monthly VaR from this? So annual VaR. So there are 12 months. So what we will do? We will simply divide it by 158.11 divided by under root 12. 12 months divided by under root 12. If we have to calculate weekly VaR, then now you get the monthly VaR. Okay, so 12 under root 1 by x multiplied by 158.11, and the answer is 12 under root 1 by x multiplied by 158.11, and the answer is 45.642. Okay, so this is monthly VaR. So for the calculation of the weekly VaR, again we have to reduce the time. So 45.642 divided by under root 4. There are 4 weeks in a month, like this. Again, if you have the weekly VaR and you are asked to calculate the 6 months VaR, then you have to take the total weeks in 6 months, and this is how you calculate the or you time translate the VaR. Then next, confidence level translation. And in confidence level translation, we will need this data. Okay, let's see. Our value at risk was daily and at 95%, and the amount was 10 million. Okay, now here we have to calculate value at risk. Again, this is daily only, but at 99%. So what are the steps here? First, remove the impact of 95%. What is the impact of 95%? 1.65, and then give the impact of 99%, which is 2.33. Simple. Solve this and you will get the answer. If we have to calculate, say, from 99% to 90%, value at risk daily 90%. In this particular case, whatever is the answer, I'll just solve this. So 2.33 divided by 1.65 and then multiplied by 10, and this is your 14.121. So this is your value at risk at 99%, and we have to calculate the value at risk at 90% now. So again, what we will do, remove the impact of existing VaR. This is at 99%, so 2.33 multiply to give the impact of current VaR, whatever you want to calculate for 90%. So 1.28, and simply solve this and you will get the answer. This will be your value at risk for 90%. Now what if you have this value at risk at 90%? Whatever is the answer, again I have to solve this. 1.28 divided by 2.33 multiply by 1.28 divided by 2.33 multiply by 14.121, and the answer is 7.757. Okay, so this is your value at risk at 90%. And here, if you are asked to calculate the value at risk at, say, 95%, but this should be monthly. Currently this is daily. Okay, so this is daily, but you are asked to calculate the monthly value at risk. Now we have daily value at risk. We want to calculate the monthly value at risk. So first step, you have to calculate the monthly VaR. Okay. So here we have to first from smaller time frame to larger time frame. So from day to month multiplied by how many days? 20 days, assuming the working day. Okay. So we are assuming working day here 20. GAF will provide you the specific information. Don't bother about it. That is like, so 20 days in a month, 20 working days in a month, like that. Okay. And then you have to also adjust the impact of the confidence level change. And here in the confidence level, our existing calculations for the 90%. So 1.28, remove the impact of 90%, add the impact of 95%, 1.65. And whatever is the answer. So simply 7.757 multiplied by under root 20 multiplied by 1.65 divided by 1.28. And you will get your answer. That's it. Fine. So this is the value at risk calculation. Just a second. Okay. Then we have the calculation of expected shortfall. So quickly we will visit notes to see the illustration. So here we have illustrations. First, non-parametric approach. Non-parametric approach. In non-parametric approach, these are our observations. These are lowest 10 observations. For 95%, you have to use the fifth value. Why? Because we assume there are 100 days, and we are taking the fifth value. So fifth value is this. Okay. For 99%, we have to take the first worst loss. So 14.95. For 90 days, we have to take the 10th worst loss, and like this. Okay. For the expected shortfall calculation at 95%. At 95%, this is your value at risk, and your expected shortfall is the average of these values, and this is your expected shortfall. Don't expect to get a calculation of the expected shortfall calculation using the parametric approach, because this will, like, the formula is really complicated, and generally GAP prefers to avoid complicated formulas in examination. So don't bother about it. Just focus on the expected shortfall using the historical method. Okay, not the parametric approach, but value at risk can be asked using the parametric approach and non-parametric approach both. These are the Z values you have to remember. Then we have the parametric approach, and this is the formula. So Z into sigma. And then we have time and the confidence level adjustment for the VaR. So first is the time adjustment. Then we have the confidence adjustment. You have to remember and read it once. Then we have the expected shortfall. This is the formula. Yeah, you can use the formula if you want to use, but not recommended from my side. Then this is the expected shortfall calculation. Simply take the average. This is simple average, the simplest possible thing. Then we have the difference between the expected shortfall and value at risk. Just remember the difference between the expected shortfall and the value at risk. And here, what is the importance of expected shortfall? Expected shortfall tells you what is beyond, what's coming for you beyond the value at risk calculation. Okay, the value at risk. And value at risk is a very specific value. The problem with value at risk is value at risk tells you what is at 95%. But it does not tell you like what's beyond that particular thing. Okay. So to assess the losses beyond value at risk, we use the expected shortfall, and this is what you need to remember. Then we have the coherent risk measure, incoherent risk measure, and coherent risk measure will fall here. Just a second. Okay. So interpretation and then coherent risk measure. So interpretation of value at risk. First, we will discuss this. So what is the interpretation? Now here we have value at risk for daily VaR. Okay, so our daily VaR at 95% is equal to $10 million. Okay, so the first interpretation is percentage based or the confidence level based interpretation. This means that on any given day, there is 95% probability that the loss will be below or equal to 10 million, loss will be below or equal to 10 million on any given day. There is 95% confidence. This is what you need to remember. So there is 95% confidence that loss will be below 10 million, and there is 5% chance that loss will exceed 5 million. And this is the problem with VaR. VaR is not telling you what is above that. Okay, so what happens if the losses exceed that 10 million loss, right? So this is the first interpretation. Second, this is the percentage or the probability based interpretation. Second interpretation is a day based interpretation. This also means, this is the second interpretation 2. This means that out of 100 days, there will be 95 days where a loss will be less than 10 million. And there will be, or there may be 5 days on which the loss may exceed 10 million. This is the second interpretation. First interpretation, second interpretation. I have already provided all the interpretation in book. So you have to remember. So just see here. So these are the two interpretations, and these are must. GAP likes to test these interpretations in exam. Then we have coherent risk measure. So coherent risk measure has the 4 properties: monotonicity, translation invariance, positive homogeneity, and subadditivity. So these are the 4 properties. If a particular risk measure, it can be anything, if a particular risk measure fulfills all these 4 properties, this means that particular risk measure is the coherent risk measure. If the risk measure is not fulfilling all the 4 properties, then we say the risk measure is not coherent. Now first let's see what is the meaning of monotonicity, then translation invariance, then homogeneity, and then subadditivity. Monotonicity, must remember, you have to remember what is the meaning of monotonicity, then translation invariance, homogeneity. You have to understand each and what is the meaning of these properties. Okay, again, GAP might test you on this. Monotonicity, if regardless of what happens, a portfolio always produces a worse result than the another portfolio. If there is portfolio 1, portfolio 2, portfolio 1 always performs worse compared to portfolio 2. This means that it should have higher risk measure. Okay, so this portfolio 2, the worst portfolio will have higher risk measure. Then second, the translation invariance. Translation invariance means if the amount of cash K is added to the portfolio, its risk measure should decrease by K. Simple. Why? This particular cash K may be replaced by risk-free security as well, the treasury bond, like that. Okay, so you have to remember this also. Homogeneity, or also known as a positive homogeneity. The change in size of the portfolio by multiplying the amount of all the components, multiplying the amount of all the components by A results in risk measure multiplied by A. So if you change your portfolio from say 100 million to 1000 million, so automatically we are multiplying it here by 10. So your risk measure will also increase by 10. Okay, by multiplying by 10. Simple. And then subadditivity, most important property for us. So for any 2 portfolios A and B, the risk measure of the portfolio formed by merging A and B, that is a combined risk of A plus B portfolio will always be less than the summation of individual risk of A and risk of B. This is what you need to remember. Okay, so this is the coherent risk measure property. So there are 4 properties in coherent risk measure. Now here question number 1, is the VaR coherent risk measure? No, VaR is not the coherent risk measure. Why? Because it does not fulfill the subadditivity property. Then, is the value at risk coherent risk measure? No, it does not fulfill subadditivity in certain conditions. Okay, generally it is subadditive, but in some conditions it does not fulfill. That's why value at risk is not the coherent risk measure. Is the expected shortfall coherent risk measure? Yes, expected shortfall is the coherent risk measure. Then the spectral measure. Spectral measure simply means the measures or the risk measures calculated by giving weight to that particular value. So value at risk is the spectral measure, expected shortfall is the spectral measure. So how value at risk is the spectral measure? Because we give 100% weight to this particular value, which is at the 95th percentile, and that's why value at risk is the spectral measure. This much is more than enough for your exam. Then is the expected shortfall spectral measure? Yes, expected shortfall is also spectral measure. Why? Because we distribute all the weight in these values. Okay, so 100% weight is distributed here. Okay, so this 100% weight was given to value at risk, a single value in case of VaR. But in case of expected shortfall, if there are say 1, 2, 3, 4, 5 values, and we will divide so 10%, 20%, 20%, 20% to each. That's why expected shortfall is also a spectral measure. Simple. This much is enough. Okay. So in this spectral measure, then we have the mean variance framework. What is the mean variance framework? We will discuss this in the CAPM lecture. And here you can just see the basic properties here. All these formulas are from the CAPM chapter. And the assumption of distribution is also included here. Now, what is the limitation of the mean variance framework? Mean variance framework assumes the normal distribution in its very base, but in reality, we don't know. In most of the cases, the data is not, or returns are not normally distributed, and this is what you need to understand. But rest of the thing you can read in detail if you want. Now, calculating and applying VaR. Here, this particular chapter is reduced because we already covered the calculating and applying VaR in the previous section only. Now here, in value at risk calculation, there are two possibilities. There is a linear portfolio, non-linear portfolio. Stocks is a linear portfolio, and derivatives, specifically options, is non-linear portfolio. Okay. For the calculation of linear portfolio, the value at risk VaR calculation for the linear portfolio, this is very simple and straightforward. Whatever we learned, Z into sigma will give you the value at risk linear. And for the non-linear, value at risk non-linear, here we know option depends on stock. So what you have to do, calculate the value at risk of stock, Z into sigma. Z into sigma, maybe if you need, multiply by V. And then for the calculation of linear portfolio, we will simply use the delta normal approach, and we know option and stocks are linked with the delta. The relationship between the stock and option is the delta. Again, you should know what is delta. If you don't know, then it is covered in the Greeks chapter, the last chapter of this curriculum. So here, what we have to do, simply calculate or use the value at risk calculated using its underlying, here I am assuming, or using stock, and multiply it with the delta. In exam, most of the times delta is provided, value at risk for the underlying is provided, and you have to calculate the delta value at risk for the option portfolio or the option, or this is also possible, the value at risk for the underlying, you need to calculate this, and then you have to multiply it by delta and so on. Okay. So both the approaches are possible. And this is the only point which is applicable here, or the new here, linear versus non-linear derivative. Historical simulation we already discussed. This is the delta normal approach. Delta is calculated like this, value of portfolio, and then you have these formulas. You don't have to bother about these formulas. You simply apply the approach I told you. Then Monte Carlo simulation and the worst case scenario. Worst case scenario means we create a loss distribution. Now remember, this is not the return distribution, This is loss distribution. This is distribution of losses. Okay. So in distribution of losses, we take the tail. So this gives us the worst case scenario. The meaning of worst case scenario means it is beyond VaR. What is the worst possibility? This is the worst case scenario. Then we have the measuring and monitoring volatility. In measuring and monitoring volatility, the discussion starts with the calculation of standard deviation or the volatility using the basic formula. We all know what is the basic formula for the formula for this is the standard deviation calculation, reading number 3. So we know there are 3 approaches. So formula, and we already know what is the formula, x minus x bar square divided by n minus 1. This is the first formula. If you get a question which requires you to use formula, don't use the formula, directly use the stat function in your calculator, feed the value and get the answer. That's it. Then we have the implied volatility. Implied volatility, we just need to know what is implied volatility. The volatility calculated using the BSM model. In BSM model, we know we use S0, X, R, T and sigma. This is known, not known. So also C0 or P0, the call option or the put option. So these are the variables used in the BSM model. So in BSM model, if we assume, and this call price and put price, if you check your market, okay, you will get the call price and the put price. So what is not known? So this sigma. So we set model in such a manner that is like whatever the volatility. So what is the value of volatility which gives us this C0 or P0, the call value or the put value? This is the implied volatility. So implied volatility simply means the volatility implied by the BSM formula. This much you need to remember. Then we use some time series models, and these are for the calculation of standard deviation. Then the standard deviation can be used in VaR. So mainly these values are used, or these calculations are used in the forecasting. So first method we have is the EWMA, exponentially weighted moving average, and the formula for the EWMA is the sigma n square is equal to 1 minus lambda multiplied by Rn square, Rn minus 1 square plus lambda sigma n minus 1 square, meaning previous day's standard deviation and previous day's return, or also known as a drift, will help you in knowing or calculating the today's volatility. In the same manner, today's volatility and today's drift will help you in calculation of tomorrow's volatility, and so on. We will do the calculation. For example, we have to just remember this particular formula. This value will be provided. This value is generally 0.94 if it is not provided, but generally this value will be provided. So lambda is always higher value, okay, 0.94, and this is 0.94, which gives us 0.06, and then we have this drift, okay. So all should be squared, and this will give you the variance. Then for the calculation of the volatility, you will simply take the under root, and this is your exponentially weighted moving average. This much model is important. You have to remember this particular formula. This is testable. You have to remember this formula. There is nothing difficult in this formula, first of all. Then we have the Garch model, Garch, G-A-R-C-H, generalized order regressive conditional heteroscedasticity. Name is not important. Garch will specifically tell you like, these are the values, and you have to calculate the volatility using the Garch model. So for Garch model, this is again the same model, okay, similar model. So alpha Rn minus 1 square plus beta sigma n minus 1 square plus gamma, and then VL. This VL is long run variance, okay. This is weight, this is weight. You already know sigma, you already know drift, and this is also weight. Now gamma and VL, long run variance, is known as the omega, okay, and there is relationship VL is equal to omega divided by 1 minus alpha minus beta. And there is one more thing you need to remember here. Alpha plus beta should always be less than or equal to 1, so that you can put some weight on gamma. That is a weight for the long run variance. So this particular model assumes the long run variance. This model simply says yesterday's volatility, yesterday's drift is important, correct? No problem with that. But what about the volatility, the long run volatility, the stable volatility for past few years, or sorry, past few days, maybe 100 days, 200 days, like that, okay? So this is a long run volatility. All these values will be provided in your examination, and you have to simply calculate it. Now, at the time of calculation of value at risk, we will, if we are using the portfolio, if you have the portfolio, we will definitely read the correlation. So as I said, for the value at risk calculation, we can calculate the sigma. But if you have sigma and if you have portfolio, how to forecast the correlation? So for the purpose of forecasting the correlation, we have to start with the covariance. Okay. So covariance. So today's covariance is equal to 1 minus lambda and plus lambda. Okay. So today's covariance is equal to 1 minus lambda, covariance of n, just a second, covariance of n minus 1, okay. So yesterday's covariance, and x n minus 1, y n minus 1. So x is value n minus 1, y is value n minus 1, and then simply add it in lambda multiplied by covariance of n minus 1. Now, when you get the covariance of n, sigma n for a particular, say, sigma xn and sigma yn. My question is, can you calculate the correlationship between the x and y for the time period n? So today's correlation, yes, we can. And if you calculate today's, then you can calculate the tomorrow's, right? So this much is important here. Remember this. Then one more important statement. EWMA is special case of Garch. where this particular term, so gamma multiplied by long run variance is 0, or simply we are putting 0 weight for long run variance. Okay, so that's all about the value at risk revision, and we mainly focused on the key important areas here. For the rest of the content, you can definitely read out the text. Okay, but as I said, most of the, like, all the key points are already covered in this discussion. So thank you everyone, thank you for watching this video. See you in the next video. Bye bye, take care.